retirement is just a few years away, it may be time to adjust your investing strategy.
The shocking statistic is that by the time somebody reaches 65, 95%, they're dead broke, they're dependent on family, or they're dependent on government.
It's important that people deal with someone to make sure to prove and provide that guaranteed lifetime income.
Welcome to the Retirement Architect, David Reyes. Our program is designed to not only provide insight, but to educate and to give you the tools you need to help you design and build a rock-solid retirement.
Well, we have the 7-year wait is over. Well, what have we been waiting for 7 years? Well, no more ZIRP. What's ZIRP, David? Zero interest rate policy. The Federal Reserve finally increased interest rates for the first time since 2006. So unless you've been under a rock, I'm sure you heard about this. And so we're going to talk a lot about this today because I want you to really understand the impact of these things. Because, you know, these news items, they say, oh, it's so important to pay attention to these things. And, you know, I always have this saying I have is that, you know, we're drowning in information and starving for wisdom. You know, the more internet feeds you read, or the more books you read about a topic that you don't understand, doesn't make us smarter, right? And so we need wisdom and that's time and real life experience. And so today I really want to put some texture around what does it really mean when the Federal Reserve raises interest rates? How does it affect you? How does it affect me, right? The Whiffen principle, what's in it for me? So the Federal Reserve raised interest rates for the first time since 2006, ending what Janet Yellen called an extraordinary period, overcoming the worst recession since the Great Depression, called the Great Recession. So interest rates were raised by 0.25%. Not a big interest rate move, but that's typically how cycles will move at 0.25% at a time. And when you're at zero, we've never been at zero for this long. You're talking since 2006. You're talking 9 years. So this is really unprecedented in how this is going to affect our economy and the stock markets and bond markets on a forward basis. So, you know, although they raised interest rates, you know, we're not sure how quickly those are going to increase over the next couple of years. The target interest rate that the Federal Reserve has through 2016 is around anywhere between 1.4 to 1.5% through 2016. And that might not sound like a big deal, but to give you an example, how interest rates work and they affect your investments. So first off, how does it affect me day to day? Let's talk about that first. Probably a better way to start. So first off, Wells Fargo was the first to raise their prime lending rate. Those are the rates that they'll lend their prime borrowers, their best borrowers. And the prime rate prior to the other day was 3.25%, and prime has now been risen to 3.5. Now, banks will follow, so it's kind of like follow the leader. Once one bank rises, they'll all raise interest rates. Here's the sad part, really sad part, is that guess what? They're not going to be raising your account rates for your CDs, for your money market accounts. The banks are going to kind of take it all. They want that money. They're trying to increase their profits. And I'll tell you, you're not going to see increases in your checking account, money market accounts, or in your CDs. So that's kind of a sad affair because the banks are really going to use that as another profit engine. So, you know, one of the first things that raises the prime rate, so it raises the cost of borrowing. It'll raise potentially credit card rates, your automobile loans, and your mortgages, you know, and right now it hasn't really affected it. As we go forward and rates rise further, you'll probably see some, you know, maybe minor or maybe more significant increases in your mortgages, your mortgage payment if you have an adjustable, or if you're looking to buy a home. Some of the fallout, the second level thinking on that is okay, if that's going to raise mortgage rates, if that's going to affect consumer credit, you could argue that that could slow down housing. That could slow down our economy. That could slow down consumer spending, which represents 70% of our economy. So there's all these secondary and tertiary parts of the economy that affects you and me. And so those are some of the most obvious areas. And so where it becomes a little less obvious is when you get down into the investment side. And I always say, if I could teach one class to clients and I teach my own clients and prospective clients, it'd be about bonds, because bonds are kind of this mystery asset. And bonds basically will go down as interest rates rise. The value of a bond will go down as interest rates rise. And unfortunately, I found that people don't understand that concept. To give you an example, if you own a 10-year bond and rates today in a 10-year bond are around 2%. So if the Federal Reserve over the next year says they're going to raise rates about 1.5%, let's just call it 1 to make it simple. For every 1% interest increase in interest rates on a 10-year bond, you would lose about 5 to 7% of principal. So if you had $100,000 in this bond, you would lose $5,000 to $7,000. So when people say bonds are a really safe asset class, that's not necessarily true. On top of having interest rate risk, most people don't realize that you can have other types of risk with bonds that they don't even realize. That's credit risk, default risk, of course, interest rate risk, liquidity risk, even currency risk. And one of the things I see that really bothers me, and a lot of you are getting hurt. I was sitting down with a client the other day, and it was this great couple that they're prospective clients right now, and I think they're going to become clients. We had great meetings with them, great couple, and they've been the same advisor for like 20 years, long time. And they're taking distributions from their portfolio, and they're now 80% bonds right now, 80% bonds. And I was educated about bonds. I'm like, wow, that's a lot of bonds. They're in their 60s, young, mid 60s. Hopefully live a long time. And I started dissecting the bonds that they had. And one of the big components of their bond portfolio, believe it or not, was junk bonds. Now, they call them high yield now. Now, high yield's supposed to, it's a lot nicer, isn't it, than junk. But they're junk bonds. In fact, the ticker symbol, if you want to look it up, for a high yield bond is JNK, is one of them. Stands for junk. Now, junk bonds are very dangerous, and I'm going to tell you a story here about some, and I'm going to tell you about a fund that's closing that's a high-yield bond fund, a junk bond fund. But I was showing this client that over the last 2 years, she's lost 17% in this, quote, conservative bond portfolio. So right now, interest rates being low is very risky for bonds, because as bond interest rates rise, the value of your bonds can go down potentially. So junk bonds, again, that pay high yields, and people chase these yields to get higher rates of return, which is dangerous. A company called Third Avenue, which was a very big junk bond high yield firm, stopped taking redemptions and ended up closing their company completely, shutting down the fund. So these are things you need to be careful about. And if you want to talk to me about some bond alternatives, some ways to safely increase your income, give me a call at 1-800-611-1967. That's 1-800-611-1967. And I'll sit down with you complimentary and review your portfolio and let you know some much better ways. We're not big fans of bonds. And so I will talk to you personally about that. And you also can reach me on the web at reyesplan.com. That's REYES plan.com, reyesplan.com. And again, 1-800-611-1967 for our complimentary second opinion. And I'm going to go ahead and I'm going to go into another segment on this because it's such an important topic. And I thought I could get through on this particular segment. But again, we're talking about bonds. We're talking about the Federal Reserve raising interest rates for the first time since 2006 in an unprecedented move off of what's called ZIRP, zero interest rate policy, but we've had for 9 years. And we're not sure what it's like this big giant petri dish experiment that we don't know what's going to happen. And the Federal Reserve seems to think that our economy is doing so great. It's not. I mean, we're bumping along. Our GDP is around 2%. You have Japan in like their third recession in a decade. You've got Europe who has negative interest rates. You got China that is devaluing their currency, that has a major slowing of economy. You have oil that's dropped from $107 a barrel a year and a half ago now to $35 a barrel. You have gold that's been cut in half. These are serious problems. So, I really disagree with the Federal Reserve raising interest rates right now. The problem is that they kind of would lose a lot of credibility by not doing so. So we're going to stick around. I'm going to talk more about some other alternatives to bonds that I feel are much safer and much better for your portfolio. And so if you want to get that second opinion from me, if you want me to review what you have, give me a call at 1-800-611-1967. That's 1-800-611-1967. Or on the web at reyesplan.com. That's REYES plan.com. Again, it's David Reyes on AM 760 KFMB.
You're listening to the Retirement Architect, David Reyes.
Common sense or amazing guesswork?
No guesswork here. The Retirement Architect,